There's a whole bunch of stuff I'm keeping an eye on right now, which is going to affect you directly. It's going to affect the stock market. It's going to affect the economy. So check it out. Here's the things I'm looking at, and there's about 17 of them. And don't worry, I'll tell you a whole bunch of stuff at the end of this video that I am doing personally and what I think is a good idea to prepare for what is to come in the next little while. I'm getting very nervous here. I don't know if you guys are seeing what I'm seeing, but I look at this stuff and I'm just watching it all come together. All the different pieces are all lining up to make what could be a very, very difficult time financially, economically for every single one of us. One of the ones which I've been talking about for a few years now. Ever since 2008, the velocity of money has fallen off a cliff. It's cut in half. And velocity of money has been lower before, and velocity is just a matter of how many times in a certain time period a single dollar is used as it cycles through the economy. It's been lower before, but it's never fallen as fast as it has now. Since 2008 till now, it's cut in half, and that's hard for businesses to adjust to that and react to it and plan for things. That's what's going to put a lot of extra strain on the economy. And I wrote about velocity of money years ago about how it was proving as it declined that the American economy was in stall speed. And you guys know all about the debt levels. We all have our own personal debts, but there's also debts of corporations and municipalities. And as the economy rolls into a recession, then you're going to see a lot of extra strain on the municipalities. We've seen plenty of major cities go into financial problems before, declare bankruptcy. That has only just begun, and it's going to actually be a rising trend in the coming couple of years as and if we enter a recession. Speaking of recession, one of the most telling signs of a recession is a tilting of the yield curve, where you're getting as much interest on your shorter term bonds that you own or IOUs that you own. You're getting more interest for a shorter term than a longer term because the outlook for the longer term is so deteriorative or so negative. So that's when the yield curve tilts. They say that that's always, some of the people act, a lot of analysts act as if that's the cause of recession. And as I've told you before, it's not a cause, it's a symptom. It's like a runny nose does not cause a cold. Having a bad cough doesn't cause you to get a cold. That's a symptom. It's a result. That's the same thing that's going to be happening with the yield curve. The yield curve is telling you that it's inverted, that therefore it's almost a perfect indicator of an upcoming recession. But in this case, it's actually, as always, a symptom of what's going to happen anyways. And it just so happens to match up with the timing of it, because as we enter a recession, the yield curve by its very nature is going to have to tilt, because the way that investors are trading based on what they expect to happen down the road in the future. And you've probably heard talk of a bond bubble, and there is a lot of risk in bonds based on everything I've been looking at. And if you're a bond investor, and there's more money, more dollars in bonds than stocks, most investors don't know that, but bonds are where the global economy's wealth is stored and protected. Bonds are a lot safer than any other kind of investment, just about. And there is a lot of problems with bonds. You can lose a lot of money with bonds. And that's especially true if the interest rates start rising, but it's looking like now they may not be rising as aggressively as was postulated or talked about a few months ago even. So there might not be as many interest rate increases, which will put a little bit less pressure on this bond bubble we're seeing build up. But either way, it's a really risky situation to be in. It's a really time for caution more than greed. You have to be very careful if you're an investor in bonds, and if the bond bubble does burst, that's going to put a lot of pressure on all sorts of businesses, banks, people all over the world. And that could be something that would be very, very disastrous for the worldwide economy and us personally for our own investments. I might have been one of the first ones, or maybe even the only one, to be talking about the double top and the Dow Jones Industrial Average Index. Nobody talks about this. I don't know why. Like, it seems to me that it was pretty obvious, but it's a very negative sign, and I really highly doubt that we would ever return to this level where it double topped out at again, or that we would ever trade higher than that. I'm wrong plenty of the time, and this market is absolutely upside down, so anything could happen. And that's all I'm going to say, is that I'll just keep on doing what I've done for several decades now, and I seem to land on my feet plenty. And a lot of that has to do with being a little bit concerned or cautious when everybody else is cheering about how awesome this market is and how good this economy is. But when you're looking under the hood and you see all this rotting engine block, and you can't ignore that. I mean, people are saying that I'm a doom and gloomer. I wasn't until I started seeing all this stuff come up, and I've been watching this, and I was early on this call, but I've been watching this build up, and it's not getting better, it's getting worse and worse. And if we had a lot of debt before, then we have a lot more debt, and then a few months later we have a lot more debt, a few hours later we have a lot more debt, and it just gets worse. And this is the way that I'm getting concerned, that it's all lining up to be what's basically going to be the back of the stock market just cracking in half, and it won't be something that slowly builds, I don't think. I believe that something's going to set off a pretty big correction towards where this market is fairly valued, which is a lot lower than where it is right now. And one of the ways you can look into this is just look at the historical price earnings ratios of a lot of companies. And people are saying that the economy is doing so well and that the corporations in the stock market are coming out with these great earnings. And yes, a lot of that was because they bought back a lot of their shares using cheap money. So there's a smaller share base so that the money they do make is divided by fewer shares. So they say, yes, our earnings are up, but they didn't necessarily make more money. They made more money per share because they have fewer shares. And so they can go around touting that all their earnings are rising, the businesses are doing so well. You should be looking at top line numbers and then bottom line numbers. You look at revenue levels and then the final net earnings. And even gross profit margins are a good thing to look at. But if you look at the stuff that matters like that, you may find out that we are actually coming out of a double topping pattern where the next move for stocks will almost certainly be lower. And we'll see how it plays out, but that's what I'd be watching for. If the market does start falling from this point on a week-to-week basis, then it may be starting a really significant trend lower. And you've probably heard a lot about European banks. They are in a little bit of financial trouble right now, and where the American banks are declining in revenues on a year-to-year basis of about 6%, the European banks are dealing with triple that amount of decline. They're dropping at 19%. And now the response to that is that they're slashing jobs, they're cutting costs, and to get the economy going, they're talking more and more about keeping the negative interest rates going and more money printing. And all of this is just inflating the money supply. The more dollars or more euros that are out there, the more the GDP of the countries are sliced up by that number of shares, so to speak. A dollar is just like a share of a stock. So if there's $1 million out there and they start printing money, now there's $2 million out there, each dollar holds 1/2 as much value of the GDP of the underlying country that's backing up that dollar. And you're seeing more and more money printing and money creation worldwide. Even in Europe and America, you're seeing it in Japan, you're seeing it in South America. And all of this is going to fuel inflation, of course, but all these central banks are digitally loaning dollars into existence, just putting numbers into a program, and then they're saying, now we've got so many $1 billion more. This is not a sustainable thing to do, and this is proven out by every country in the world that ever survived and paid their bills by printing more money. And we're doing it, but it's being done worldwide. And you see hyperinflation in certain pockets. You see very significant inflation in other countries. And a lot of that has to do with how much money that they're spitting out. They're using monetary creation as an amusement park to pay for all the bills, the things that they've already spent, and now they have to pay for all these liabilities and obligations. And just a few weeks ago, I was telling you the geopolitical points I'm watching for potential risk factors. And one of the ones I talked about was Kashmir. And Kashmir is a disputed area between India and Pakistan. And since I made that video and pointed out that flashpoint, which has been grumbling along for years and years and years, since then, this was just a couple of weeks ago. There's been a massive terrorist attack in the Kashmir region. There's been a responsive military strike against a group of potential terrorists. And then there was a battle between the fighter jets of India and Pakistan. One of the Indian jets was down. They took the Indian pilot hostage. Luckily for everyone, they've released him already as a sign of goodwill and good faith. But the point is, the Kashmir region is a tinderbox, and it's been sitting there grumbling along for a long time, but we are in a more precarious situation with this disputed region than we have ever been before. And so people are watching the South China Sea, they're watching what's going on with Venezuela, but who's watching Kashmir? Because that is two nuclear powers who have, I told you before, why do people go to war? For ideology, religion, territory, and resources. The four reasons, that's it. India and Pakistan are on different wavelengths religiously, first of all. They've got a long history, especially in the Kashmir region. That could easily become something very significant, more so than even what's going on with the South China Sea, for example. So keep your eye on what's going on with Kashmir on an ongoing basis, because if things get really bad there, which they very likely might, just like when I was talking about Venezuela, how bad it was getting. A couple of years ago, I was telling you that there's problems there and there's no medicine on the shelves for kids, there's no food. It didn't get better, it got worse. Things always seem to get worse before they get better. And I believe that's true with Kashmir too, and I hope that cooler heads prevail, and if they don't, they could set off something that will really rock the entire global economic and military and political system. And now we're seeing slowing growth in China. China's economy and its growth is what's fueled over half of the global growth we've seen over the last few years. And even China, who their numbers sometimes may be coming from the Communist Party, and maybe they're not as reliable as you would like to see from financial figures, but they have even admitted themselves that the growth is slowing dramatically. It's going to put pressure on all these economies across the world, including us, because if their growth is what's fueling all of the world's growth, that's the main growth driver, and all of a sudden it's fading away, and all the other countries are also growing, they're also seeing big declines, like America, for example. We're seeing a slowing growth rate, and it will only get worse before it gets better. This is what's going to happen. There's going to be a major slowing in the Chinese economy. It's going to be coming to light, and this is going to give a lot of more weakness and headwinds against companies that were banking on some international growth. So a conglomerate, a company that has businesses worldwide all over the place, they're going to be affected more by the slowing growth in China than other companies. But overall, we're all intertwined now. This is one big basket, a big Jenga game, where as China slows down, so will we pretty significantly. And just so you guys don't think that I'm negative all the time, because I'm not, I'm quite the opposite. Anyone who knows me will tell you that. But the home price affordability index is making it harder, or is saying that it's harder for a young family to afford a home right now than ever before. That brings me to the good news. The good news is that real estate prices are absolutely going to be coming down now, especially the really high-end stuff. There's going to be a lot of houses in the Hamptons, for example, or Aspen, Colorado, Vancouver, that are going to lose more than 50% of their value, probably closer to 80%, 70% or so, by the time this all plays out as I see it going. So there's my good news for you. Home prices will be declining if you're looking to buy a place, but also too, if you own a home and you live in the home, don't worry about the price fluctuations. It doesn't matter if home values drop 80%. If you're in the home that you own and you live in it, it doesn't matter what the price is. And there's a lot of pushback, people saying the economy is so strong, and they're talking about, or they're citing the low unemployment rate to say how strong the economy is. And as I've told you many times, a low unemployment rate is actually a detriment to businesses, small businesses operating in the economy. It makes it more expensive and more difficult for them to function, which is also partly why you see so many big stock market crashes or recessions, which happen right at the lowest unemployment rate that you see. You might see a really low unemployment rate, and then there's a stock market crash or recession pretty quickly soon after. But then you say, I don't understand, because the economy is so strong then. It's actually a warning sign. When you see a low unemployment rate, that can be a warning sign that we're about to tilt over a cliff. And that's what's happened many times in the past. This is what I believe is going to happen now. And the way that they calculate unemployment is they ignore huge swaths of people. They say, well, if you're not this and you're not that, then we will count you. And they go, well, look at how low the unemployment rate is. Right. You can make it even lower. You can make it half this low or half as high. You cut it in half, basically, if you were to change the way you calculate things. And this is what they do. They can always show you the lowering unemployment rate. They can always show you a strong economy even when it's weak, and this is what's happening. And the one thing that you need at the top of a market, when things are overextended before they come back down, the one thing you need to see is a bunch of people who do not agree. They need to be here telling you the reasons you're wrong, why they disagree with you, why what I'm talking about doesn't agree with their worldview. That's a necessary stage before the mud hits the fan. And I've been telling you guys for a long time about the Q ratio. It takes all the value of all the stocks on the stock market, compares it to the cost to replace the assets of those stocks. It's gotten above 1.05 times in history. One time it got to 0.98, and one time during the dot-com bubble, it got up to 1.68 or something like that. Right now, it's at 1.17. Every time it's approached or touched 1.0, that's an unsustainable level. The stocks can't be worth more than the actual intrinsic value or the underlying fundamental value of the stocks which make up the stock market. Every time it hits 1.0, within a very short time, by short I mean it'll take a couple of years sometimes when it first hits 1.0, every time it's followed by a very significant and a historical stock market correction. And by correction, I mean crash, but I'll say correction. So right now, the Q ratio is at 1.16 or 1.17, I believe. It's way too high either way. It's the highest it's been since any time except for the dot-com bubble. And this is the way it's going to go. Just like the dot-com bubble went, just like the recession in 2009, the Great Recession, I guess it's called, all of that, it's indicated by Q ratio spikes. Right now, we're at an unsustainable level, and therefore, we have to return to a historical average, or actually overcorrect and go down below the mean, which means that the stock market has to decrease in value to correct and readjust the Q ratio's value. That's what happens every time, over and over again. And I've told you that you can tell market tops and market bottoms for stocks or indexes by an increase in the volatility. And we've seen a massive increase in volatility for the overall markets, which would either indicate that we're a little bit more investor uncertainty about what things are worth, also indicates the top or bottom of a move. I believe that it would be the top of the move and that things will come back down, as opposed to it being a bottom that we're going to increase a lot from here. I don't think there's a lot of growth from the current point to where we're going to go. I believe there's a lot of decline, and that's going to play out, and you're going to see it as I see it in front of our own eyes in the coming months. That's why you'll get up in the morning, you'll see that the Dow Jones has had major intraday swings where it's down 200 points and then up 400 points in the same day. That volatility is absolutely indicating something to you. It's indicating that we are closer to a market top than a market bottom, and we're definitely not in the middle of an uptrend or downtrend, because the volatility is too extreme. There's huge swings. The market's going up 300 points, down 300 points the next day, up 300 points the next day. That isn't the way it used to be, if you remember, even back a couple of years. This increased volatility, even the volatility between the bid price to buy a stock and the sell price or the ask price to sell a stock, that spread, even that is actually increasing. There's a lot of volatility increasing across the board. The beta of a lot of stocks is increasing above 1.0. Beta is just a measure of how volatile a stock is compared to the overall market. So their beta is 2.0, is twice as volatile as the overall market. We're seeing increases in beta, we're seeing increases in daily price swings, we're seeing increases in intraday price swings where it's down strongly and then it goes up strongly, or it's up strongly and it goes down strongly during the day. Sometimes even in the same day it'll go up and down both. That is increased volatility, and it's everywhere right now. Nobody knows what any assets should be worth or valued at. That's what happens when you get to the top of a market. There's indecision, there's uncertainty, and there's a pushback from both sides saying the reason that they believe that what they think is right and the reason they believe is right. It all comes down to what historically happens again and again, and that's what I'm banking on, and that's why I've been in business for decades and decades now. I'm a survivor, I guess. I don't know. Whatever. Next point. So, as promised, I'll tell you some of the things that I've done to prepare for this and profit from it and prevail and survive. And this is not financial advice. I don't give advice. I don't tell you what you should do. I don't care what you do. I'm telling you what would maybe help you if you want to look into it is to take a look at what I'm doing, and maybe some of this is going to be right for you. Some of it won't be right for you. I don't know. What I'm doing is I've bought a lot of physical metals, gold and silver, and still silver is my #1 call for 2019 of the best investment of all. Silver miners. The silver ratio, silver to gold ratio is at a whack. Silver is, it's taking about 80 ounces of silver to buy 1 ounce of gold. That's historically absolutely intermittent and transient. It's going to go back towards closer to silver to gold ratio of maybe 40. So silver is going to increase by a lot more than gold increases, and when gold declines, silver is going to decline by less. And if you look at some of the last few days of trading, you can see that where gold goes up 0.5% and silver goes up 1.3%. That is just going to happen again and again with every fluctuation in price. You're going to see a little bit less of a decline from silver than gold, then you're going to be seeing a little bit more of an increase in silver than gold until the silver to gold ratio normalizes. I also am very significantly believing that a recession is right around the corner. It's going to show up a lot sooner than people are talking about. They're all throwing out numbers like 2020. I do not agree at all with that. Here's the thing. So I'm investing in stocks which are a little bit more recession-proof, such as drugstores that sell pharmaceutical stuff or Band-Aids, medicine, that kind of stuff. People buy that regardless of the economy. I'm also looking into a lot of military technology stocks or companies that are having such high growth. We'll talk about them at peterleeds.com for subscribers, but a lot of these companies grow so fast that they'll grow faster than in a decline in the stock market, and that makes them a much better investment because they're going to hold their value in contrast to other assets which are declining in value. I also got anything to do with luxury, watches, fancy cars, all that kind of stuff, and I'm giving a little bit more weight to stocks that are lower end eating establishments or dollar stores or that kind of thing, anything that helps you save money. Other businesses that help other businesses and people save money, that's going to be in a lot more demand in contrast to the typical blue chip stocks that you see out there. I've also significantly lightened my exposure to all kinds of stocks. Most of the stocks I own right now are gold mining companies, gold trusts, silver mining companies, and a lot of these businesses which help other businesses and people save money. And in general, I'm focusing on more fear than greed. This is not a time to speculate. This is not a time, in my opinion, to put money into something like, say, Bitcoin and hope that you're going to make all this money from it. There was a time when you could have done that, and maybe there will be a time again in the future. But right now, this is not the time to reach out or extend your head out to try and take advantage of every dollar. You want to protect yourself, and these are the investments that are going to do better overall anyways. So if you protect yourself by investing in companies and businesses which are a little bit more recession-proof, then that may become a much better investment, such as, for example, a funeral home company or a rendering plant or any kind of business which makes money basically at the same rate no matter what's going on with the economy, such as a utility. Those are the types of investments that pay a small dividend, where that is going to sort of hold its head above water no matter what's going on with the rest of the economy. There will still be contagion effects where if the entire stock market's crashing, then yeah, the utility company might also be under a little bit of pressure, but not as much as all the other stocks that are a little bit more exposed to what could potentially have a lot of negative effects if there is a recession. So if this is your first time here, my name is Peter Leeds, and this is all the kind of stuff we talk about. So subscribe to the channel, please. And if you want to know more about any of this or get your own copy of the Market Manifest for free, swing over to peterleeds.com and pick it up.